Gentlemen, thank you so much for being here. I think there's a big discussion in the markets and in the global economy right now. What is the bigger problem? Is it inflation or is it slowing growth? Just this morning, we saw the Eurozone tipping into a technical recession. Mr. Grünschau, what's your view?
Well, we're facing a challenging environment for 2023. When we put out our projections back in April, we're projecting that global growth would slow down to about 2.8% this year, and then it would increase a little bit next year in 2024. Now, 2.8% at a global level, this is one of the lowest growth levels. So we have a slowdown in growth, and we're seeing that in a number of countries. And in part, this is on the back of the increase in interest rates that many central banks around the world have implemented trying to tackle inflation. So we're still dealing with inflation pressure gone yet. Growth is slowing. And then we have, on top of this, I'm sure we'll come back to that, we have had some financial and banking fragilities in recent months, and then there are some concerns about where we might go from there.
Absolutely. Mr. Jordan, the Swiss economy is always incredibly resilient. Will it stay that way?
Well, we hope, of course. No, it's really a very complex situation, a very complex environment. We still have this issue with inflation globally, but also in Switzerland. I think central banks should really be focused on bringing inflation back to price stability. In Switzerland, that would mean really sustainable below 2%. And at the same time, the economy is not in a recession, but it's not really a boom. So it's a relatively moderate growth. And we have this international financial stability problem where it's some vulnerabilities. I think this is really a complex issue, and central banks have really to be focused on their main mandate to bring inflation back to price stability.
And it has rarely been this challenging for you as a central banker to balance both. But I want to come back to inflation because you said inflation is still high. Is it really? It's headline inflation just above 2%, core inflation back below 2%. In a way, you can sit back and relax. The US and the EU, they still have an inflation problem, but not Switzerland.
Well, you are right. If we compare Switzerland with many other countries, nevertheless, inflation is above our threshold for price stability. We also saw now globally, but also in Switzerland that the inflation creates cost. So we really have to bring inflation back, and we have to make sure that inflation doesn't go up again. So it's really something that we have to figure out exactly, that we have the right policy. And we know we have second round effects, third round effects, so inflation is probably more persistent than initially assumed. So we have really to stay focused on really bringing inflation down. We saw really this cost of inflation everywhere, but also in Switzerland, so it's really important to bring inflation back into the territory of price stability.
You're well aware of this argument of greedflation, of profit-led inflation. Simply companies, they're passing on higher prices to customers, even though the price increases aren't really justified. The cost pressures, the underlying ones, have in fact come down. How much of the inflation that we still see in the world are brought about by that, the greedflation argument?
I don't like the term greedflation too much. I mean,
what do you like?
Well, we had, I prefer price-on-price inflation. I think what we've had is a situation where there were a number of sectors that were constrained, and there was very strong demand because there was a lot of support coming from authorities, monetary policy, fiscal policy. In an environment in which you have limited supply and a very strong demand, it's very natural for prices to rise. It doesn't reflect all of a sudden a greed motive or anything like that. So I think some of that translates into comfortable margins for a lot of firms. And then as inflation is coming back down, these margins are going to come down to more normal levels. One of the things we're not too concerned about at this point at the IMF is the risk of a wage price spiral. So there is another narrative out there that we need to make sure that wages will remain low, because if somehow wages start rising, then it will feed into prices, and that will make this inflation process more persistent. We have to keep in mind that in many countries around the world, real wages, once they're adjusted for cost of living, have been coming down a lot. And that's the flip side of these margins for firms having been going up. And so there's a lot of room for these wages to catch up without necessarily triggering a lot of inflation. Now, having said that, I will agree with Thomas, which is, when we look at the overall inflation picture, a lot of the decline we see recently is mostly because the price of energy has been coming back down. And so we see that in headline inflation and things that, are quite salient for most people. But the underlying core inflation it's more persistent, and it's reflecting some of these dynamics that we just described. And so we have to be concerned about bringing back down this core inflation towards central bank targets.
And there is an additional headache in Switzerland coming our way in the sense of the reference rate for mortgages and for housing, and that may add more upward pressure on the inflation rate as well. You will be meeting very soon, your central bank, other central banks. They're sort of coming to the end of the line in terms of raising rates further. How far are we away from that?
Well, we have to also realize that we've had a massive increase in policy rates, not just in Switzerland, but also the European Central Bank, the Bank of England, the Federal Reserve. Pretty much the only countries that haven't increased rates recently, large economies, would be Japan and China. And so we've had a massive increase in policy rates at a very, very fast pace. It's within less than a year almost. And so at this point, there's a lot of increase in tightening in monetary policy that's in the pipeline. It's starting to affect the economy. It's starting to work its way through mortgages, through borrowing rates, et cetera. And we have to be careful a little bit that we don't overdo it. So I think it's very appropriate that at this point, central banks would pause, assess, and then see where it's going from there.
Mr. Jordan, I was talking to a businessman this morning, and he said, well, I hope the SNB is not going to be raising rates too much further because we don't want the Swiss franc, to appreciate any further. What needs to happen for your monetary policy to normalize?
Well, our main indicator is our inflation forecast. When we are sure that inflation stays below 2% in a sustainable way, then of course we are in an equilibrium. We do not have to tighten monetary policy further. But I really have to stress here, we are at 1.5% policy rate. This is very low. So we had a very long debate also among us here that negative rates are problematic for pension funds, for the banking system, etc. So we are not so long ago out of this negative interest rate environment. 1.5% is relatively low. We know we have those effects, especially on the reference rate and then on rents. But we really have to bring inflation down to price stability. It's not a really good idea to wait and then to have inflation much higher and then to combat inflation with much higher interest rates. Then the negative impact would be higher. So I think we still can be very lucky with relatively low rates. And you mentioned the exchange rate. Of course, we are looking at that very carefully. But also there, we have to make really the distinction between the nominal exchange rate and the real exchange rate. So we had this much higher inflation abroad compared to Switzerland. And that's then also an opportunity to have a nominal appreciation of the Swiss franc without having a real appreciation of the Swiss franc. So not harming our economy, but rather shielding our economy from the inflationary pressures from abroad.
And that's why inflation here has been so much lower than in the rest of the world. Let's talk about the impact of the rising rates. When you take a look globally, there are so many concerns about the office space, about real estate, about CRE, commercial real estate, and the loans that are sitting on the bank's balance sheet. Is the worry about that, is that overdone?
I think a lot of the concern with the commercial real estate, especially office space, and when you look at the US in particular, is not so much, of course, the increase in interest rate is not going to help. But the troubles are coming from before. The trouble has to do with the change in working practices coming back from COVID, and the fact that office space is much less used than it used to be. And so, to give a number to your audience here, if you look at a major city like San Francisco, the highest occupancy rate would be on a Wednesday. Mondays and Fridays have much lower occupancy rate for some reason, I don't know why. And then on Wednesdays, the occupancy rate is barely at 50%. Now, you can imagine that with something like this, there's going to be a massive reorganization of space. A lot of companies are going to want to scale down how much office space they're using, and maybe there won't be a lot of, the rents will have to come down. So that is weighing down on the developers. Now, that's going to weigh down on the banks or holding the, if you shoot the loans to the property developers. And so that's the dynamics that we're dealing with here. And I think more broadly, what you have with the increase in interest rates is compounded when you look at commercial real estate.
Mm-hmm. What about Switzerland? When I talk to real estate investors here, they say there's no problem at all. Will there be a problem in Swiss real estate?
Well, this is an area that we are analyzing very carefully because it could have a big impact. Well, we have very high real estate prices, both commercial but also, of course, individual rental and residential real estate. And usually when interest rates go down, we have a massive increase in the value of this real estate, but vice versa. So it should be of no surprise that when we increase rates, both equity, bond prices will fall, and the same impact we have exactly also on real estate. So that would be of no surprise. In Switzerland, we have a little bit a different situation because we have relatively limited supply of real estate. Land is very scarce. So we have not built that many apartments recently. So demand is very high, supply is really limited. But nevertheless, with increasing interest rates, just because we have these financial principles, we would not be surprised that we will also see some moderation in house prices.
All right, gentlemen, are you ready to talk about the elephant in the room? That is the banking sector. Let's just get to it. SVB crashed in the United States, and that was a clear example of maturity mismatch. A couple months ago, you said this banking crisis is contained. Do you still hold that view?
I mean, we think that there have been very forceful actions by the authorities, both in the US, when you look at SVBs and First Republic and other regional banks. Before that, if you go back to the fall, we had also an episode in the UK with what was called the LDI and the pension funds that was also related to the increase in interest rates. It was not in the banking sector, it was the non-bank financial institutions, but still there was something that created some risk for financial stability. And then, of course, but I'll let Thomas talk about this, there was the Swiss collapse of Credit Suisse. And I think in all of these cases, we've had very forceful actions by the authorities that have been able to contain the situation and prevent contagion. It was very important to prevent contagion and avoid a situation there would be massive panic in the market and there would be massive sell-offs and then asset price would have collapsed. And I think that has been very successful. Now, does this mean that all the risks have been contained? I think that's a little bit too early to say that. I mean, I think there are still some vulnerabilities in some of the regional banks in the US. We still see some of the vulnerabilities there, even after the most recent developments. And one has to be worried and one has to remain very vigilant on things that might happen both in the banking sector and in the non-bank sector, both in the US but also in Europe or in emerging market economies.
Now, the maturity mismatch, that was not the problem at Credit Suisse. A long list of problems, among them cultural mismanagement, management mistakes. As such, when you went to Washington to the IMF World Bank meetings shortly after the emergency rescue, what did your colleagues say? Did they say, thank you, Thomas? Or did they say, how could this even happen? Why did you leave it so long?
Well, they mainly said, thank you, Switzerland. And I think it was a big relief for everybody that Switzerland was capable to find a solution in such a short period of time. And it was very clear that without going into that solution, not going to the takeover Credit Suisse by UBS, we would have been in a financial crisis, economic crisis in Switzerland, but Switzerland would have been the trigger of an international financial crisis. So I think that was clear for everybody. So people were relieved, everybody, that Switzerland was on such a short period of time capable to find a solution and really to not let the global economy, global financial stability put into a big crisis.
But then we created a whole different problem, one of the so-called monster banks, NZZ called it. We've got one in the US, we've got one in Switzerland now. JP Morgan, are you not worried about what happens when one of these banks fails? Because then the state is on the hook.
Well, it's clear that when you have large financial institutions like JP Morgan or others, there is a need to have very careful supervision to monitor the risks. Obviously, there is the potential for having a lot of impact if something goes wrong. But I think that's why we have special regulations in place for globally systemic banks.
But they didn't work this time.
Well,
they didn't apply.
I mean, I think some of the problems with Credit Suisse were flagged for a long time, and I think the authorities were already sort of working on them. So it's not that it's all started in March. So I think there is no doubt that there will be some sort of assessment of what worked and what didn't work going forward. But I wouldn't say that things didn't work.
Mm-hmm. What about the too big to fail regulation in Switzerland? It did not apply. That's something that was very clear during the press conference that even the Swiss finance minister thought, wow, this is incredible. It did not work. What do we do about the huge bank of systemic risk in the future?
Well, I have to say it was a very specific situation, and I think the Swiss authorities came to the conclusion that resolution under those circumstances would not stabilize the situation. So we had to find another solution, and the risk was just too big. So we did not then decide for resolution, but rather for the takeover by UBS. Now, of course, we have this situation, and we have to look now carefully what is necessary. There will be a big review in Switzerland. There will be expert groups, the authorities will look at it. And there are a couple of things that are very important. I think the entire question regarding resolution, how can resolution work under those circumstances? Then liquidity will be a very important issue. How can we maintain the liquidity within the bank? We had these extreme outflows, not only at Credit Suisse, but also in the US. And we have also to see how banks can prepare better to have enough collateral in such a case so that central banks can then provide the necessary liquidity.
Mm-hmm. Mr. Jordan, can I ask you a more personal question? And I know in your job, you can't act emotionally. Your job is to always be prepared, and the way I've known you over the years, impeccably prepared and almost very neutral. What did that do to you? Because the finance minister recently said in an interview, I didn't know whether it was Thursday or Saturday or Sunday. How hectic was it? And what do you do with the criticism that has been leveled at you? For example, from the former chairman of Credit Suisse, things were left for too long.
Well, I think you get used a little bit to this situation. You have to remain calm. And now regarding criticism, we are also used to that in different dimensions. And we also learned to discount this criticism. But yeah, it was a very hectic situation. It was not an easy situation. But I think at the end, I think all authorities together with UBS and Credit Suisse, we came to a solution that really avoided a big financial crisis. And I think that should always be the starting point of any further discussion.
Can this be a success story for Switzerland?
No, well, the fact that we lost Credit Suisse is of sure not a success story. It would have been much better if we had still Credit Suisse. It was an important bank, historically a very important bank, but this is really a loss for Switzerland. On the other hand, I think that Switzerland was capable to deal with this situation, to avoid a big financial crisis, etc. I think this is something that is also a very good result.
All right, let's get to some audience questions. Thank you so much for sending them in. Tricky one, but you're the academic, both of you are academics. The central idea of modern monetary theory is that governments with a fiat currency system under their control can and should print as much money as needed because they can't go broke. How could the concept of new monetary theory influence the current situation?
Well, I think I will have a simple answer to that, which is I think the events of the last year have sort of demonstrated that it doesn't work. I mean, you have a situation where even the proponents of modern monetary theory would say that once inflation rises, you have to do something. Well, inflation is there, so we have to do something. It cannot just be printing money. So I think at this point, we sort of have to realize that when you have an inflation problem like we have globally, it requires addressing it with the tools that you have at your disposal, and these tools are central banks reining in demand by raising interest rates, raising policy rates, and moving away from a very accommodating policy like they had before to address the problems of that time.
All right. Is it the new reality? Another question from the audience, that let's say every decade, states will have to stabilize one of their core banks is too big to fail at the end. Mr. Jordan.
Well, financial markets are always vulnerable, also the banking system. This is almost by definition because they change or they create side deposits and deliver mortgages and long-term loans. So I think we have to live with that, but we have to do everything that the risk, especially for the taxpayer, is minimal. So I think everything we do with regulation, with preparation, should be done by the aim to avoid a financial crisis, but also to shield the taxpayer and the public at large.
All right. Mr. Jordan, Mr. Gorenscha, I want to thank you so much for your time. Appreciate it. Thank you.